All right, today we're going to break down some fascinating new research from the Macro Butler. We're going to connect the dots between geopolitics, central banks, and of course, your portfolio. You'll see why the real story isn't what the Fed is saying out loud, but what history teaches us about the undeniable link between the war machine and the printing press. Let's dive right in.
So that recent Federal Reserve meeting, it was a perfect example of how to talk a lot without really saying anything at all. As the Macro Butler put it, it was a masterclass in saying almost nothing with great precision. So what was the real message hiding between all those carefully chosen words?
The official statement, it's always engineered to sound calm and project stability. But if you look a little closer, you can see them quietly admitting that things are, well, a bit more challenging. It really shows a central bank that isn't setting the agenda anymore. It's just reacting to events out in the world. Okay, so check this out, because this slide really shows you the gap between their words and the underlying feeling. On the left, in the official statement, you see this subtle but really important downgrade. They went from describing the labor market with some signs of stabilization to the much weaker little changed. But the really juicy part is on the right. This sentiment model, it tracks the tone of Chairman Powell's remarks. And you can see a clear, even if it's small, step away from being dovish, pro-rate cuts. This suggests that while they're publicly admitting things are slowing down a bit, behind the scenes, they're actually getting more nervous about inflation.
And then, of course, the press conference just poured gasoline on the fire of uncertainty. When he was asked about oil shocks, Powell gave what the source hilariously calls an impressively comprehensive forecast, which basically means your guess is as good as mine. And on the risk of stagflation, he rejected the comparison to the 1970s, only to then describe what sounds exactly like a modern version of the same old problem. So it's really no surprise that the markets basically shrugged off the Fed's whole performance. The real drama, the main event for traders, was happening somewhere else entirely. It was the spike in oil prices after a strike on a major gas field. Geopolitics, not monetary policy, was the one driving the bus that day. To really, truly get what's going on here, we have to throw out the modern economics textbooks for a second. We've got to look at the original and, frankly, the far more practical reason that central banks were created in the first place. So this mind map here lays it all out beautifully. On the one hand, a central bank's official purpose is to be the referee and the emergency doctor for the financial system. Manage the currency, set rates, keep things stable. But look over to the other side. Its real job, the practical mission it was born to do, has always been about one thing: helping governments pay for wars without having to completely empty the treasury. And this whole playbook, it actually started way back in 1694 with the Bank of England. Its goal wasn't to manage the economy or smooth out business cycles. Nope, it was to fund a war. And the solution was just genius, really. Create a bank to lend money to the government, print banknotes to represent that new debt, and then turn around and sell that debt to investors. Simple. And that powerful model, well, it became the blueprint for pretty much everyone ever since. The U.S. Federal Reserve, which got started in 1913, found its true calling just a few years later, helping to finance World War I with Liberty bonds. It did the exact same thing in World War II by forcing borrowing costs down, and then did it again during the Vietnam War, which ultimately unleashed that massive inflation we saw in the 1970s. So all of that history brings us right back to where we are today. Let's see how this historical pattern has led us directly into the trap that investors are facing right now: classic stagflation. So this is the million-dollar question, isn't it? When the economy is slowing down, everyone expects the Fed to do one thing: cut rates. But what happens when that slowdown is being caused by an inflationary shock, like a huge spike in oil prices? What does history actually show us? This chart screams the answer loud and clear. That purple line? That's the Fed's main interest rate. The green line is just a ratio of stock prices to oil prices. When it's falling, it means oil is getting really expensive. And the lesson here is absolutely unavoidable. Every single time an oil shock has caused an inflationary bust, the Fed has ultimately been forced to raise rates, not cut them. And this gets to the absolute heart of the problem. The Fed's tools, they're completely useless for this kind of fight. I mean, a central bank can't drill for oil, it can't open a mine, it can't unblock a shipping lane. All it can do is hike interest rates, which just slows the economy down without doing a single thing to fix the real problem: the supply shortage. And when you have that kind of mismatch, you get what the economists politely call stagflation. But it's not polite at all. It's really the worst of both worlds.
Inflation stays stubbornly high because the supply problems are still there, while economic growth just quietly vanishes under the weight of those higher rates.
Okay, so let's get down to it. In a world where the printing press is being called on yet again to fund the war machine, what on earth are you supposed to do with your portfolio?
The Macro Butler boils it all down to these key takeaways. First, the Fed is just a spectator here. It's not the main player. The real drivers are energy and geopolitics. Second, stagflation is on the horizon, which means the idea of deep rate cuts is pretty much a fantasy. This all points to a stronger dollar, higher treasury yields, and of course, higher prices for both oil and gold, with gold being the one asset that stays calm in the middle of the storm.
So for this exact environment, the source lays out a very specific strategy for preserving wealth, and he calls it the Banana Republic portfolio. It's a balanced approach, 50% intangible, real assets, think physical gold, silver, and platinum, and the other 50% in really solid businesses that generate real cash and don't have a lot of debt. And, crucially, be very, very cautious with long-term government bonds.
So at the end of the day, the message is pretty clear. Navigating the next few years is going to require a portfolio built on a really clear-eyed view of history and risk. It's about being prepared and being prudent, not having blind faith that central banks can somehow control events. They just can't.
All right, if you want to dive deeper into these ideas and get more in-depth analysis for your own strategy, here is exactly how you can connect with a Macro Butler.
We really hope this explainer has helped connect some of the critical dots between war, money, and your investments. For more from the source, you can find all his work at themacrobutler.com or just reach out directly via email.